There are two tax codes in the United States. People believe that it's one for the rich and one for the poor, but in reality, it's one for the informed and one for the uninformed. We want you to be informed. Join us on Consider This program today as we'll break down the differences in the two. Good morning and welcome back to Consider This program. I'm your host, Joe Clark.
And I'm Aaron Rheaume.
Happy to have you along, Aaron. Hey, buddy, we are talking about when taxes meet investing, part two. First time, we had Brett Spangler, one of our CPAs at the Financial Enhancement Group on, talking about tax reporting. You can go back and look at that if you, anywhere you listen to podcasts, you can go back and get subscribed to those, automatically have them downloaded. I've been doing a podcast since 2007. Most of those are not available anymore with some of the changes in technology, but you can still go back way into the 2019 period of time if you like to listen to some of the shows that are out there. Aaron's our director of financial planning. That's where we're proactive as opposed to reactive on the reporting side. And we're talking about when taxes and investing meet. So right now we're going to talk about tax brackets. So Aaron, buddy, first question.
Sure.
What is a bracket?
A bracket just tells you where you're going to pay tax at. So think of them in the form of stair steps. We've got a 10% bracket at the bottom all the way up to 37% at the top. And some ancillary charges, but...
So the bet, I mean, he hit it head on. Best way to think about it is a series of stair steps. So there are people, and this is where you get into some of that craziness of the politics, right? There are people who will tell you that over half of our country doesn't pay any taxes at all. They are correct in terms of what we're talking about now, marginal brackets, as they're called, but they're incorrect in terms of not paying taxes because if you have a job at all, you pay taxes into Social Security.
Yes.
You know, so tell somebody who has a bunch of taxes taken out of their check that they don't pay taxes, and either run faster or be bigger because you're in for a discussion of some nature. So a bracket. Just think about a stair step. A bracket tells you how much money is taxed at a certain percentage. So married filing jointly, after your taxable income is above that threshold with your itemized or standard deductions, you've got an amount of money that you're going to pay taxes on. That first bracket or step is that 10% bracket. And then you take a 20% bracket, not on all of your money because you leave some behind on the first step. Right? Yep. And then you continue to go. Now, this is important as we get into the next question. So there are two types of taxes you hear us talk about with your 1040. One is effective tax rate, and one is marginal tax rate. So, Aaron, what is the effective rate? How do you figure that out?
Effective rate is the average of all of the dollars that you pay. So if you pay some at the 10% bracket, some at the 12, some at the 22, it's the average on all of those dollars.
The average taxes that you paid as you went through those brackets and those steps. And so what's the marginal?
The marginal is where your last dollars are going to be taxed. And so to kind of clear up a misconception, let's just say you fall into that 22% bracket. A lot of folks think that they're paying tax on all of those dollars, so all of the dollars are being taxed at 22%. It's not the case. Some's being taxed at 10, some at 12, some at 22. That's where you get the effective rate. It's the average of where they're being taxed.
So we've got effective and we've got marginal, right? So which one should be my focus when?
Marginal should be focused when you're doing tax planning. So what we're helping people with is looking where we're going to add money or take away money from a return. That's where we're focused on marginal. Effective, it's not as important in my opinion because it's looking at the average of your tax dollars. CPAs are focused on your effective rate. I want to know what we're going to do to that marginal rate when we're adding or taking away from income.
So, and I get from tax planning, since I taught you all that, it's kind of hard for me to argue, but I do have a caveat.
Shoot.
When we look at retirement runway, right, and think about an airplane on the tarmac, right, you've got accumulation, you're adding money to your plane, right? You got preservation, which you're at 30,000 feet on the airplane, and then you've got distribution. What are our two goals in distribution?
the managing volatility, so market up and downs,
that would
and
be
the
one.
effective tax rate that you're paying.
There you go.
Gosh,
right?
dang, you threw me right into it.
Yeah. I knew it was in there. But seriously, when you're doing the tax planning, right? So here's somebody who thinks about this stuff all the time, and it's easy to get tied up on the radio. You got to remember, I've done this for 22 years, right? And I'm leading the witness because they're my questions, so I'm able to take you where I want to go, right? But the bottom line is to be able to back those all out and to think about them again in concert, not a single item or a single issue, but to be able to look at it and go, okay, effective tax rate really doesn't matter at all when we're doing tax planning, and we're going to explain why here in just a second. But it does matter in terms of distribution of that average dollar that's coming out. So what Aaron is wanting to do is to help you position yourself over your financial journey when you're going through accumulation and preservation to get you in a place that when you go into distribution, when you go to land the plane, that the effective tax rate is lower. You do that by effectively maximizing the marginal rate along the way.
Yeah.
Right? Now, so let's go in and let's talk about a strategy, because you can itemize or you can take a standard deduction. So what are the differences between the two?
Standard deduction is the allowable amount that the IRS sets that you can take off your return each year. Married filing jointly this year, I think it's like right around $25,000.
Pretty close.
And then your itemized deduction is what you're able to, what I would coin the term as write-off. So mortgage interest, charitable gifting, your SALT tax, and then any medical expenses as long as it's higher than a certain percentage of your adjusted gross income.
The big three are your charitable state taxes, which are now limited under the SALT tax.
Yes.
Your state and local taxes are what we call SALT taxes. But your mortgage interest and your charitable contributions are the biggie. So the IRS from the standard is going to give you, let's just call it $25,000 for free, or you can itemize, right? And this is what the IRS wanted when the tax code was changed, what Congress wanted when they changed the tax code. But the last numbers we saw out, as many as 90% of tax returns that are filed are taking the standard deduction. And this won't surprise you. Aaron used the word write-offs. The majority of mistakes, that be quote unquote, if you're not watching on video, mistakes occur when they're actually doing the itemized deductions, where people might be adding to the facts. Let's just
embellishing.
Embellishing. There we go. You can kind of put it that way. So
goodwill donation.
Right. So let's say I made $100,000 of adjusted gross income.
Okay.
All right. Barb and I are under 65. You get a bonus when you go above 65. We're under 65, and we're married filing jointly. So of that $100,000 of joint income, how much comes off if I take the standard deduction?
25.
That means I have $75,000 of taxable income.
Yes.
Right. And that leaves me inside of the 12% tax return.
Yeah.
12% bracket, right? That's where my top bracket is. So anything that we can do in that 12% bracket we want to do, what are some things I should consider?
Well, in your situation, you're leaving $5,000 on the table because the top of that bracket is about $81,000. I think it's $81,050 to be exact. So you want to at least see if there's $6,000 that you can use or draw from the IRA in a tax-efficient way. Maybe convert that to the Roth. But the other things that you want to think about is maybe there's some capital gains that you need to recognize for the year instead of taking income from an IRA. Because capital gains, if you're in that 12% bracket or below, you don't pay any federal capital gains tax.
Zero, nada.
So,
right? I wrote that up in an article and I got sent back to me. There is no such thing as 0% tax rate. It's like,
yes.
Yeah, there is.
Yeah.
Ladies and gentlemen, there are two tax codes in the United States. It's one for the informed, one for the uninformed. Do not be the latter. I mean, the reason you're taking your time to listen to the show is so we can give you ideas of things that you want to consider. So remember, for a Roth conversion, so let's say Barb or I, either one, had money in an IRA, a tax-deferred account. Aaron has done the tax planning. That means it's been prior to the end of the year. And there's another $5,000 I could pay taxes on at 12%. If you do a Roth conversion, there's no penalty. Money's coming from the IRA, going directly into my Roth IRA. At $100,000, I qualified income-wise. Didn't matter what I had at work, right? I had earned income, All right. When you're doing a conversion, by the way, you don't even have to have earned income.
Yep.
But took the money out of the IRA, $5,000. It was going to be taxed at 12%. Right. I pay the taxes today. Bada boom, bada bing, and I got it done. In the capital gains, and here's where it becomes important. A lot of times, people fail to step up their own basis. Right. When you're doing this on your own, let's say you've got space in $5,000 that's left. You've got a stock that you like. You really don't want to sell it. You've got a very low basis in it. You're proud, giving the high five sign. Remember, Aaron told you the capital gains rate is 0, right? Is 0. All you have to do is go in and sell it and rebuy it pretty much at the same time, right? With a capital loss, you've got to wait 30 days to buy it back. With a gain, it's instantaneous. So at 0, you tell your broker, hey, sell it and buy it. And the broker's going to look at you like, what? Sell $5,000 worth and buy $5,000 worth. All you've done is stepped up your basis. Next year, you may not be in that low of a bracket. The rules may change, but you've protected part of your capital. And ladies and gentlemen, it is a financial journey. That is your job. So what else do you want to tell us about tax brackets, Aaron, or anything? If you're talking to your wife or your dad or your daughters, what would you tell them?
Just make sure you're effectively maximizing those. So if let's say you're edging up against that standard deduction based on charitable gifting and mortgage interest. Let's say between the two you've got $23,000, $13,000 is going to charities, $10,000 is mortgage interest, and you're borderline taking that standard deduction. Maybe if you have the cash flow, we might encourage you to do your gifting that year again, so you're given an additional $13,000 and taking more advantage of being able to itemize and playing the standard deduction game.
So when you come to see us at the Financial Enhancement Group, we call that the double stack.
Yes.
Right? And you can go to yourlifeafterwork.com or call us at 800-928-4001. Merely say you want to get signed up for a next steps meeting. Aaron or somebody on our advisory team will spend 90 minutes with you. We'll give you things that you're going to want to consider today, things you're going to want to consider in your future, and if we choose to partner together, things that FEG will do for you, and we'll put it in writing. You can give us a call at 800-928-4001 or go to yourlifeafterwork.com. Your next steps meeting.